Now, just think about this, right? This could be the inverted hammer, or it could be the old triple Lindy pattern. That's what we used to call it when used to trade on the trading desk. Let's just think about the action here. The bulls are in charge. The blue team is pushing it up. Now, here on this day, it got all the way up to here, right? All the way up to like around 158, 159. But what happened by the close? The sellers took over and pushed it all the way back down. So sometimes the leadership changes over the course of an extended period of time. And a lot of times that can show up on a pattern as like a rounded top or a rounded bottom. Sometimes the leadership changes in one day. And that's kind of what you're seeing here. In the morning, it looked like the bulls were firmly in control, but by the close, the bears came in and overpowered them. And sure enough, this was a sign that the market was going to head lower. And that's what happened. So whatever the name of this is, we don't really care. The important thing to see is if when I look at this tells me, all right, we opened here, we got all the way up to here, but by the close, we were all the way back down here. So the sellers came in and flooded the market. So
and then look what happened the next day.
Yeah, exactly.
The flooding resumed.
Like here you have, this is another traditional candlestick pattern, right? We would call this a bearish engulfing pattern, or in Western terminology, we would call it an outside reversal day. But just think about this, right? The red candles are down days. On this particular day here, it looked like it was going to be another down day in the morning because this is where the opening price was. But by the close, the bulls pushed it all the way back and took over. And the trading action engulfed the prior day's trading action, which is where the name came from. And this showed you that the trend was changing there. And you can even see the same kind of a thing here, right? It looked like it was going to be another down day, but by the close, the bulls pushed it all the way back up. And then that told us that the trend was changing. So I think people get too caught up in like saying, is it this pattern or is it this pattern or that pattern? And they don't really understand that the price action that makes these levels form, or I should say makes these patterns form. I mean, you can see here, we go back to paycheck, you got your clear support, clear resistance up here. And this is good to know because a lot of times it's hard to figure out where to have a target. So if something is going up and it's trending higher and you're thinking like, boy, I got a profit on this stock, where the hell should I sell it? It would be illogical to have your sell order at a level that had been resistance before. I mean, it's not perfect, but there's a good chance we're going to get up here and run into resistance. Someone might say, you know what, I'm going to sell it if it gets to 156 or 155, but they're just guessing. This resistance is around 154 and a half. So it might get to 154 and a half and then roll over and go down. As we talked about, the sellers might start undercutting each other, right? So the person that guessed missed out. The person that let the market tell them what to do put their order in the right place. Of course, selling it at 154 isn't as good as selling it at 156, but it's better than missing it and watching this thing trend all the way back down to around 145.
Yeah, but getting filled at 154 is better than not getting filled at 156 and having it trend all the way back down.